Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Q3 Market Update, Macro Drivers, and Software Stock Technicals. This video presents a direct informational narration of the source document. Alright, let's jump right into the explainer. Today, we're looking at a market that is pretty much stuck in a low-volume holding pattern. Why? Because everyone is just waiting on Wednesday's critical US CPI data. Right now, the four major indices are seeing shrinking volume, so yeah, it's mostly a quiet waiting game out there at the moment.
Here's our roadmap for today. We're going to start with this macro waiting game we're in, along with its big three drivers. From there, we'll dive straight into the granular technicals, kicking things off with an unexpected pullback we saw in Google, checking in on the broader software sector, and wrapping up with a rapid-fire breakdown of some key individual stocks.
Moving right into that first point, the market's waiting game. The absolutely crucial thing happening right now is this holding pattern. I mean, major indices are just seeing incredibly low volume. Literally, only the Russell is showing a slight uptick, as investors essentially just sit on their hands ahead of this big inflation report.
And this number right here, 48%. It brilliantly illustrates exactly why that data is just so critical. You see, the recent non-farm payroll report has already driven expectations for a September Fed rate hike way down. Just yesterday, it was sitting at 51%. Today, we're down to 48%. The main takeaway here is that if tomorrow's CPI isn't outrageously high, that supportive tailwind for the market should only get stronger.
Okay, let's zoom out a bit and look at the three major macro market drivers right now: oil, interest rates, and AI.
According to the source document, these are really the big three drivers pulling the strings at the moment. First up, we've got oil prices. Now, while geopolitical conflict definitely exists, there seems to be this mutual hesitation to escalate things to a full-scale war, which is effectively capping any severe energy price spikes. Second, interest rates. Because those energy prices are contained, inflation is somewhat suppressed. And that's huge because it gives the Federal Reserve the much-needed flexibility to potentially hold rates steady. Third, of course, is artificial intelligence. If we look at Q2 earnings, core AI and semiconductor companies are still performing incredibly well. And crucially, major tech firms haven't cut their 2026 capital expenditures. In fact, some have actually raised them.
But you know, what's really interesting here is the flip side of all this, the risks. What happens if things don't go perfectly? Well, if geopolitical conflicts drag endlessly into the November midterms, markets are going to lose patience for sure, especially if gas prices start to spike. Second, if inflation proves to be stubborn, that could easily force the Fed's hand into swift rate hikes. And finally, those AI earnings expectations we just talked about, they are sky high right now. If a company that was expected to grow its spending by 30% suddenly drops that projection down to 15%, the market is going to treat that as a massive, massive headwind.
All right, let's pivot to some specific companies, starting with Google's rather unexpected pullback.
So amid a mostly quiet market, Google really stood out recently by taking a 3.6% drop. When the source document digs into the why here, it points to a potential drag on EPS coming from the valuation of Google SpaceX investment, which is basically reversing some of its unrealized gains. But here's the thing, look at their core fundamentals. They are entirely intact. The structural uptrend and that previous breakout in the $134 to $144 range, that hasn't changed at all. The source actually described this pullback as essentially, quote, accelerating in reverse to pick up passengers, so it could very well be viewed as a potential buying opportunity.
Moving on, let's take a look at the technicals for the broader software sector.
This is important because as the IGV goes, so go its individual components. Right now, the IGV index has been consolidating right around that $103 to $104 mark. The absolutely critical point here is that it must definitively break through the $107 resistance level to open up a true structural uptrend. Without that breakout, the sector is really just trading in a range.
Which leads us perfectly into our individual stock breakdown. Let's see how these key software stocks are actually faring.
We're going to do a rapid-fire look at these components based on the source data. First up, Oracle. It's boxed into a really tight $10 structure right now, and it desperately needs that broader IGV index to break out. Then there's Palantir, which failed its $19 breakout and now has downside risk down to its $13.4 support gap. Salesforce, on the other hand, is sitting at a very low base, but if it can clear $198, that could open the door to a solid 20 to 30% upside. Next up,
into it. It's holding support nicely, but it really needs to clear 426 to resume a strong run. And finally, Adobe had a high-volume support bounce and is currently testing its 200-day moving average right at resistance. Now, just to show you exactly how incredibly sensitive this market is right now, let's look at App11, ticker symbol APP. The stock dropped nearly 6% in a single day. And why? Well, an analyst downgrade questioned its growth estimates. The overall market expectation for 2027 growth was sitting at 31%, but the analyst estimate dropped it to 30%. Literally just a minor 1% discrepancy was enough to push the stock down on high volume, bringing it dangerously close to its critical $317 support level.
So, as we wrap up this explainer, the big takeaway from the source document is that we are currently lacking immediate upside catalysts, but we do have some major events on the horizon. This includes crucial retail sector earnings coming up next week, which are a huge cornerstone for the S&P, as well as the Global Central Bank Conference at the end of the month. As we wait for these major macro puzzle pieces to fall into place, how are you positioning your portfolio? Feel free to share your strategy in the comments.